And I want to quickly introduce Peter, who is a certified public accountant right here in Kenya, having earned his qualifications at the Strathmore Business School in 1998. His professional journey began as a prominent auditor in an audit firm where he served as well as a tax management consultant. Peter has actively pursued executive leadership training programs, enhancing his skills in senior level management and leadership before joining ACON in 2007, and has held several leadership roles in different organizations, contributing significantly his expertise in the current position. So, with over 15 years of experience at ACON, he has been instrumental in shaping the business strategic direction and driving financial, tax, and operational efficiencies. Peter is also a proud member of the Institute of Certified Public Accountants of Kenya. Ladies and gentlemen, Peter Jenga. Welcome, sir.
Thank you, Marina, for the introduction. Good evening, ladies and gentlemen. I'm here to take you through the capital structure and the financial performance of the ASA REITs. The CEO took you through the ACON business model. We talked about the various sources of capital. I will be talking about how we deploy that capital in developing and running the assets. But I would like to add that over the last few years, since inception of the REITs, we have diversified the sources of capital by opening new sources of capital and increasing the amount of capital that we are raising from these sources on an annual basis. Vuka has become an increasingly critical source of capital, and we see it becoming the most dominant source of capital into the future. So how do we deploy capital in the ASA REITs? To start with, debt in the REITs is governed by regulations. Unlike most other developers who have no regulation whatsoever on how much debt they can put in their developments, the ACON REITs have regulations that govern how much debt can be put into the two REITs. In the DREIT, the amount of debt is capped at 60% of the total asset value. And currently, by end of 2024, our debt level stood at 43%, which is well within the regulatory limit. In the ACON income REIT, debt is capped at 35% of total asset value, and we closed last year at 24% of the asset value, which is within the regulations. We have also set our own internal policies that guide us so that we remain within the regulatory limits. In the DREIT, each project is funded by up to 65% of debt, and the balance of 35% of the project cost is funded through equity. But because the debt, the early stages of each project is funded from equity, and because the projects also accumulate capital appreciation along the way, the 65% of the project cost is always within the 60% regulatory limit. In the IREIT, every property that is acquired can be funded by up to 35% by debt, with a balance of 65% being funded through equity. But because only some of the assets in the IREIT are funded through debt, that's how we are able to remain within the regulatory limit. Debt is secured through separate assets which are housed in ring-fenced special purpose vehicles to mitigate against cross-collateralization. The Econ REITs have undergone extensive due diligence from Tier 1 private equity funds, DFIs, and local Tier 1 lenders. The local Tier 1 lenders need no introduction. You are most likely familiar with most, if not all of them, from Stanbic to NCBA, ABSA Bank, Cooperative Bank, who are actually the trustees of the Econ REITs, the Kenya Commercial Bank. These are brands that are familiar with you, but you will all agree on the level of due diligence they take a borrower through before they can agree to lend the money to you. Because the REITs have borrowed from these banks, then you can take comfort from the fact that the REITs have been taken through proper due diligence by the banks. Then there is Celtaflic, which is a Pan-Africa housing fund that gave us the original debt that funded the first two projects, that's Jogoo Road and Ruaraka. On the other side, we have Helios, which is a London-based Africa-focused private equity fund. They gave equity, the first equity that funded the original assets, and they had taken Econ through a lot of due diligence. There is the Private Infrastructure Development Group, which is a DFI funded by a couple of European governments, Canada and Australia. And PIDGE operates through a couple of subsidiaries. There is Emerging Africa Infrastructure Fund that invested in our green board, which you may have read in the media that we retired in November last year. There is Infraco, which is another subsidiary of PIDGE, and Infraco provided the anchor equity in the Econ REITs that helped us to set up the two REITs. And then there is Garantco. Garantco is another PIDGE subsidiary, and it provided the 50% guarantee on the Econ green board. So in summary, when you're investing in the Econ REITs, you can take some comfort from the fact that the REITs have been taken through extensive due diligence by sophisticated capital providers. I'll take you through the debt management in the IREIT, which is the fund which the Vuka investors have been investing in. We have our financials that we just published this afternoon. And if you look at the column named Levered, we managed to hit a 1 billion rental income mark this year, which is a significant milestone. Our operating expenses stood at 48 million, leaving an operating profit of 651 million, which is a 60% operating margin. We had a valuation gain of over 300 million. And then a significant finance cost at 440 million, leaving a profit before tax of 535 million. This left a distributable income of 229 million, which represents a 3% yield, 4% capital appreciation from the valuation gain, making a total return of 7%. However, as you may have read in the media last year, we secured a significant amount of debt from the US DFC. DFC is a US government DFI, which gave us $180 million facility that will enable us to fund up to 65% of the capital requirement in our DREIT for the next 10 years. And up to 35% of our capital requirement in the IREIT over the next 5 years. that amount that is going into the IREIT as debt will be priced at between 8 and 10%. And if in 2024 the debt that we were carrying was priced at that 8%, it would have reduced our finance cost from 440 million to 190 million, significantly increasing our profit before tax to 770 million and boosting the distributable income to 444 million, representing 6.5% yield, and boosting the total return to 9.97%. However, if we had managed to raise this capital from the capital market as equity, our profit before tax would have been 961 million, increasing our distributable income to 635 million, and our cash yield to 8.2%, total return to 10.8%. So the takeaway from these numbers is that the IREIT is actually delivering the target return of between 10 to 11%. The only challenge you have faced over the last 2 years is the expensive debt that we have had to put in the IREIT. I'm sure you are familiar with the pricing of debt that the market has witnessed over the last 2 years, and especially in 2024 when borrowing rates went to up to 20%. So what is our strategy on debt management in the IREIT? In the past, we have used debt to drive expansion of the portfolio because running a REIT requires a certain scale for it to be optimal. And now that we have achieved that scale, we are currently working on how to replace the current expensive debt with cheaper debt. We are in the market to raise a corporate note that will put cheaper debt in the IREIT. And finally, we'll be able to eliminate the debt from equity. Into the future, we are only going to fund the acquisition of assets in the IREIT through the DFC debt, which will be priced at 8 to 9%, which means that it is not dilutive of the returns that will be paying to our equity investors. And we will also use that debt to continue driving the portfolio expansion without negatively impacting the equity returns. So how has the REITs performed? The DREIT in 2024 has returned a profit of 800 million, and the IREIT returned profit of about 600 million shillings. It's combined made a total of 1.4 billion shillings. And as I said earlier, we have released those results this afternoon after going through the audit and the necessary approvals. We project that each of the two REITs will return a profit of about 1 billion each, making a total of 2 billion. And you can see for the first time now the DREIT, the IREIT will grow, the portfolio will grow to a scale where it can achieve the 1 billion profit mark. The DREIT performance has been boosted significantly this year after the DREIT completed the first set of its own originated development. Previously, the DREIT was developing assets, completing assets that were seeded from the sponsor of the Econ REITs, and these assets were acquired at a significant level of de-risking, which meant that they were only expected to achieve a certain level of return. But with the D-REIT starting to complete its own originated developments, the performance is expected to improve as we go into the future. We had also faced some health and safety incidences some time back in 2021, which affected the performance of the D-REIT due to delays, closures that we had to close some of the sites. But over the last 3 years, we have significantly strengthened our management framework, which has reduced the risks associated with health and safety significantly. It means that we can expect the D-REIT to continue performing without serious incidences. On the I-REIT side, as I said earlier, 2023 and 2024, performance was affected by the expensive debt in the I-REIT. But with the debt management strategy I've just articulated, we expect that the performance of the I-REIT into the future will improve. And this is important to the Vuka investors because currently that's where your investment sits. We hope to replace that debt with the cheaper debt and into the future infuse affordable debt into the I-REIT from a DFC facility. The Econ REITs are not just about financial returns. You will be pleased to note the other significant impacts that the REITs have on the economy. I will just highlight 3 of them on this slide. Job creation, the Econ REITs have so far created over 57,000 jobs through direct jobs, indirect jobs, and induced jobs. And we project that over the next 10 years, we will be able to add an additional 176,000 jobs, which is a huge impact in the market. We also have a significant impact on the local supply chain. About 90% of our materials are sourced locally. And so far, we have worked with over 390 subcontractors and suppliers. And we have injected over 12 billion shillings in the local supply chain. We estimate that we'll grow this number of partners to over 460 partners, and we'll be able to inject over 30 billion Kenya shillings in the local supply chain over the next 10 years. With regard to the number of youths or students who have stayed with us so far, we've witnessed over 21,000 students living with us. And this is because throughout the year, we have students who complete their courses and they free their rooms, and new students who take up those rooms. And we have also accommodated over 1,200 students from marginalized communities through a sponsorship with MasterCard. We estimate that over the next 10 years, we will accommodate over 340,000 students. In conclusion, despite the difficult economic environment that businesses have faced over the last few years, the Econ REITs managed to deliver returns during this period when they were undergoing establishment. Secondly, we have deployed debt to achieve scale in the REITs. But going forward, we have a very clear plan on how we are going to reduce the cost of debt in the I-REIT so that we can boost the returns to the I-REIT investors and replica investors. This will be done by infusing affordable debt from the DFC facility to grow the portfolio without diluting investor returns. Thank you very much. I look forward to your questions.